Hi, class. This is my final video for the semester for sure. This is a review of exam 4. Uh, I hope that you are ready to go for exam 4 right now, and that you have been following the game plan I laid out 2 weeks ago. If you are following that game plan, which includes skimming the textbook, watching all of the videos I have out there on YouTube. You can find the links to those in Canvas under Rumbo Lecture. Hopefully you've been through all 5 of those. You understand the materials. You pause the videos and work practice problems, and then started the video and watched me work it. That is the way to succeed in this very difficult class. Even though the exams are open book, open notes, you're not going to have time to go look at your book and look at the notes. You are going to have to know the material before you start that exam this coming Thursday, April 30th. The exam will be open from 9 a.m. to 10:20 p.m. Do not wait till the last minute, because my accounting lab slows down in the evening. You want to be there in the morning or early afternoon. You want to knock this out, and then you want to go celebrate a great grade. So again, exam 4, this is chapters 10 and 11, very, very doable. People usually make a higher grade on this exam. If you do not study, you will fail this exam. That is, this course is merciless as it proceeds. And so this review, I'm going to be pretty fast-paced here, assuming that you've been through all the materials already and that you're ready to go start doing the study plan. So as we do this, I would ask you again, as in the other videos, pause the video after you see these are re-polling questions, multiple choice questions. They'll be very similar to what's on the exam. Pause the video as you see the multiple choice question, work it out, answer it, and then restart the video and see whether you got it right or not. If you're missing any one of these, then guaranteed, guess what? You're going to miss many questions on the exam, because some of these are just 1 or 2 multiple choice, but there will be 5 or 6 multiple choice on the exam from each one of these types of multiple choice you're going to see here in this review. If you are not doing well here, get back on track. Go look at my videos. Those are in detail. They're very focused on what's going to be on the exam, give you a slower paced chance to review the material, understand the material, work some problems out, and then watch me work problems out, and then proceed. I would say, again, the magic bullet here for this course is the study plan. So go into the study plan for chapters 10 and chapter 11 and work the multiple choice of those. You can skip the fill in the blanks, just do the multiple choice. So with that, I'm going to get started here. Again, I believe that I've worked very hard for you on this exam 4. I want to see you succeed so badly. Unfortunately, I will record in Canvas the grade that you earn, and I'm just hoping that it's going to be a high grade. But it's up to you, not up to me. I know that, but I am pulling for you. Don't let me down. Go out there, work hard, be prepared, and knock this exam out. And then you can relax during final exam week, because you will not be taking a comprehensive 2010 accounting 2010 exam. That is very, very difficult. 50 multiple choice covering all of the chapters we've covered in the course. It's not a fun exam. It is not fun to study for. So do your best on this next exam 4 and finish out strongly here and skip the final exam. That's what I want you to do. I'm working hard for you. It's your turn. You got to work hard for me. And again, thank you for this semester. Really hard not being in a classroom. I missed the classroom. I miss you guys. But it is what it is. Let's not be defeated. Let's win. Okay, guys? I'm going to start these problems now. Let me share my screen. All right, I'm sharing my screen with you here. There's a beautiful picture of Vermont, one of my favorite places in the world. I used to live there, but here you go. And I'm going to turn some of these lights off. I think it won't affect the thing. So let's take a look at this multiple choice. What I would like you to do is work this problem, pause the video, come up with your answer, and then I will show you the answer. So pause the video right now. All right, so what's the company going to do? They're going to issue 10,000 shares of stock. Let me do one thing here. All right, let me just pull this all the way out of here. Now we got some space here. All right, push this back a little bit. Okay, so the company's issued 10,000 shares of stock. So this is a journal entry. There are a multiple of questions, multiple choice questions that will require you to know this journal entry, and it'll come at you from different angles. And so issue 10,000 shares of stock for $10 per share. Par value is $1. So how much cash is the company going to receive? It's going to be 10,000 times 10. So we're going to debit cash for $100,000, and we're going to credit the common stock account, and this is how this entry works every time. We're going to credit the common stock account for the number of shares times the par value, so $10,000, and we're going to credit additional paid in capital for the remainder, $90,000. So there's the journal entry. Let's see if I can find that somewhere. Okay, there's debit cash for 10,000, 100,000, credit common stock. Okay, answer is C. I hope you got that right. If you didn't get that, you are going to be in trouble on the exam. You will not pass. So you want to start working on this right now. It's really pretty straightforward, simple stuff here. So pause the video, take a look at this problem, and be ready to answer this. Okay, so the company's going to pay $50 per share, and they're going to purchase back 1,000 shares. So they've issued a whole bunch of shares. Companies purchase this back, and they put it in what's called treasury stock. And it's debit treasury stock for just the amount, $50 times 1,000, 50,000. And they had to pay for this, and they paid for it in cash, so credit cash for 50,000. There you go, answer D. One thing I want you to think about here, this is a debit to treasury stock. It's a negative to equity. Remember, equity carries a credit balance as its normal balance. So when you see a treasury stock account, it's always going to have a debit balance. It's a reduction in equity. All right, next. Dividends, lots of dividend questions on exam 4. All right, pause the video, answer this, and then restart it, and I will let you know what the answer is. All right, we have 3 dates for dividends: the declaration date, the date of record, and then the payment date. And so in this example, they declared dividends of $1 million on April 1st. So that's the declaration date. Date of record is April 15th, shareholders of record on the 15th, and the payment date is April 30th. So April 1st, the company has created a liability. They've declared dividends. They cannot change their mind at this point. So we're going to be crediting dividends payable, and this is on April 1 because this is the declaration date. What do we debit? Retained earnings. How much? They didn't tell us. Oh, 1 million, 1 million, 1 million. So why are we reducing retained earnings? Because remember, retained earnings includes all the net income the company's ever made, less dividends paid out. So this is a reduction in retained earnings when we declare a dividend. And so remember, equity has a credit balance. So here we're debiting retained earnings. We're reducing equity and reducing retained earnings because a dividend has been declared and it is a payable. All right, next. Again, lots of these questions also on the exam. So I will pause. I would ask you to pause the video, answer this, and then restart it and hear the answer. Okay, so the company has authorized 35 million shares. That means legally they can go out and issue up to 35 million shares. How many have they issued? Issued 20 million. So they have room to go issue another 15 million, but they have not. And so this is going to be sitting in the common stock account, by the way. Common stock account always includes number of shares issued times the par value. And so that's in the common stock account. But guess what? They repurchased. So we have treasury stock of 5 million. So the company has issued 20 million, but they bought back 5 million. Remember, reduction in equity. So outstanding shares equals issued minus shares in treasury stock. So outstanding equals 15 million. 20 million minus 5 million equals 15 million. Answer is A. Why do we care about outstanding stock? Because only outstanding stock can vote and receive dividends. It's a big deal. Company cannot vote their own shares that they repurchase in treasury stock. All right, next. Pause the video, answer this, and then come back and restart. All right, so again, similar problem. Authorized shares equals 50 million. And then issued shares, let's see, they don't, guess what? They don't tell us how many have been issued. This is where they're going to get you on the exam, clearly, if you're not ready. And so, but we can look, the balance in the common stock account was 10 million. There was 10 million in the common stock account and 25 million additional paid in capital. So I've got $10 million in common stock account. And that's where the trick is. We know we only put number of shares issued times the par value in the common stock account. How much is the par value? $1. So if I divided $10 million by $1, then I have 10 million shares issued. In other words, in this common stock account, I've got 10 million shares times $1 equals $10 million. So issued shares, 10 million. You can be really intimidated by this kind of question on the exam if you have not practiced this in the study plan or here with me. So go back and look at this. Now, what else is left? How many shares are sitting in treasury stock? Repurchase shares, they repurchased 5 million. That's a negative. Outstanding shares equals 10 million issued minus 5 million that the company's repurchased. So there's only 5 million outside in the hands of shareholders. Answer is A. Next. All right. Another dividend question. That's good because you're going to have a lot of these. Pause the video, answer this, and then come back and I will walk you through it. All right. Again, we have the same, very similar question before. There's the declaration date. They declared dividends on April 1st. For the date of record on April 15th, and April 30th is the payment date. So April 15th is the date of record. Everybody who owns a share of stock on the date of record, April 15th, will receive a dividend when it is paid. When it's going to be paid? April 30th, the payment date. So all we're going to do on April 15th is gather a list of the shareholders that we have to pay on April 30th. Therefore, there is no journal entry, none of the above. We do not make a journal entry on the date of record. Boy, are they going to try to get you on this on exam. You know they're going to try to trick you on this. So that's a good one. Date of record, no journal entry. Next. Pause the video. Again, same problem. There is your declaration date. Here's your date of record, and now we're talking about the payment date. So on the payment date, what are we going to credit? For sure, cash, 1 million, because we're going to pay these. Are we going to debit retained earnings? No, we did that on the declaration date. We're going to debit the dividend payable for 1 million. If you look at the T account for the dividend payable, we put $1 million in there. We credited that dividend payable on the declaration date, April 1st. We debited retained earnings, credited the dividend payable. So we got a payable out there with a credit balance, but now we've paid that on the payment date. Therefore, we debit that dividend payable goes away because we no longer owe that anymore. That liability is reduced down to zero with a debit. And so the debit is to dividend payable. Answer is C. All right. All right, here you go. Another really good exam question. Good to know this one. Everything I'm doing here is good to know. I'm not picking something for you to look at here and review that you're not going to have to know next Thursday. All right, there's two primary components of equity: paid in capital and retained earnings. Those are the two primary components. What's in retained earnings? That's net income less dividends. Okay, paid in capital represent all the accounts where people have given the company money for ownership interests. What are those accounts? Common stock, preferred stock, if we issued preferred stock, and obviously additional paid in capital. And so if we look at this, common stock, yes, that is a paid in capital account. Preferred stock, yes, paid in capital. Man, I hope you can see that. Additional paid in capital, So A, B, and C. Both A and B, but not C? No. A, B, and C would all be considered paid in capital. There you go. There's the right answer. Okay, that's it for chapter 10. If you missed any of those, you don't understand those, guess what? You are in trouble. You need right now to go make sure. I would stop this video, go to chapter 10, watch my videos on chapter 10. They're not that long, and then come back and and work from there. And then come back and redo this video again, and then get right into the study plan. You don't have a lot of time here because Monday, Tuesday, Wednesday, that's it. And then Thursday's the exam. Come on, guys, finish strong. Get this done. I cannot encourage you strongly enough here. So here goes chapter 11, which is the cash flow statement and understanding the cash flow. So here's the first one on chapter 11. Take a look at that, read it, and try to answer it on your own. Pause the video. Okay, this one is kind of a solve for X thing, and we can just take accounts receivable and look at that. We start with what is the beginning balance. They don't tell us, but it increased by 50,000. So let's just start with zero. You put whatever you want here, and increased by 50. During the year, we had revenues of $1 million. What do? Credit revenue for $1 million, debit accounts receivable for $1 million. How much did we collect from customers? I have a $50,000 in. I'll come at you two different ways. I just put a 0 and 50 there. You can put 50 and 100 there. Whatever it does, it's not going to change the answer. So I say 0 debits plus $1 million debits minus X equals 50. That's going to be 950,000. Answer A. Another way of looking at this, hey, AR increased. Remember our indirect method, plus 50 becomes a minus 50 to cash. So I take $1 million in revenues on credit minus 50, 950. There's two different ways to go about that. All right, take a look at this one, read it, pause the video, work it, and then come back. All right, so cash flow from operations, and we're gonna use the indirect method. So we start with net income. Net income, 300,000. Accounts receivable increased by 50. Accounts receivable is an asset, so assets went up. They work in the opposite direction on the cash flow statement. So AR, I'll just call this a change. It went plus 50, that's opposite direction, minus 50. Inventory, that's also an asset. Inventory change. Plus 100 becomes a minus 100. And then accounts payable, liability, that goes in the same direction. So accounts payable change is going to be a minus 50. And we also see here depreciation, accumulated depreciation increased by 25. So we got to add depreciation back plus 25. So I need to do that. Anything else there? I think I'm good. So remember, whenever we debit depreciation expense, we credit accumulated depreciation. Accumulated depreciation went up by 25. And so I've got to add back that non-cash expense. So I've got 300, minus 50, minus 100, minus 50, so it's minus 200, 100. Let me just bring this out. Let me do it this way. I need my trusty calculator here. 300 minus 50 minus 100 minus 50. Let me start over again. 300 minus 50 minus 100 minus 50. I'm at 100 plus 25, 125 plus 125. Again, plus 300 minus 50, that's 250, minus 100, 150, minus 50, I'm down to 100, plus 25, 125. Answer is B. Next. All right, Guys, I'm gonna just be honest with you. If you are struggling here on the cash flow, you are gonna fail this exam because there are, 12, 13, just questions exactly like these on the cash flow statement. You got to know this backwards and forwards, and you will not have time. You won't even be able to use the book to figure this out. If you don't understand the logic, you're gonna be lost on the exams. If you're lost now, you're gonna be lost in the exam. Guess what? Get unlost quickly. You don't have a lot of time left. Okay, and so we can see that we have here, they sold one of their warehouses, and the net book value of the warehouse was 100,000, and they recorded a $5,000 loss. So guess what? I know how much cash received. That's easy. $100,000 minus a $5,000 loss. They received $95,000 in cash. However, because we are going to be using the indirect method on the cash flow statement, we've got to take that $5,000 loss and we've got to add it back. In cash flow from operations, we've got to add back $5,000 because we have a $5,000 loss that's recorded in net income. So we start with net income. It includes this $5,000 loss. So we got to add back that 5. And then in cash flow from investing, how much cash did we receive? 95,000. So I'm looking for an addition of 5,000 to operations and $95,000 increase in cash flow from investing. Let's see. There you go. Addition of 5,000 operations and the $95,000 answer is C. Next. All right, here's a similar one. So if you missed that last one, now you understand the logic. Go make it happen. Pause the video, answer this, make it happen. All right, what happened here? So the company had $100,000 net book value. And this time they sold it, they had a gain. That means they sold it for more than 100,000. How much more? 5,000. So cash received equals 105,000. I know that's going to be in cash flow from investing. So there's a possibility there. I already know the answer. It's got to be D because that's the only one with a $105,000 increase to cash flow from investing. But there is going to be this problem that we start with net income in cash flow from operations in the indirect method. So we subtracted 5,000 to get, because it was we increased that net income by 5,000. So now we got to subtract 5. So we're going to have a minus 5,000 in cash flow from operations. Again, if you're lost here, please go back and watch my videos on the cash flow statement. I worked 3 different cash flow statements there. This is going to be, it's actually relatively simple. You learn it, you practice it. You can. That's why I believe 100 is viable on this next exam. But you can't do it by just showing up. You're going to have to practice this. This is very doable, very learnable, very manageable. But you've got to practice it. You can't practice it Wednesday night. You will fail miserably. You got to be working on it. Hopefully you've been working on it the last 2 weeks. So here's the next one here. Please go work this one here. All right, so they're asking for cash flow from operations. So it's going to get a little harder for us here. This is where you're going to have to, and it's almost, you have to do a cash flow statement to be able to answer this question, in which if you go look at my videos, you can actually go do a cash flow statement. So cash flow from operations, we start with net income, which is given to us, plus 100. And let's just go down each of these. Let me just. Sorry about that. Each of these. And so acquisition of equipment with cash, well, that's an investing. That's not in cash flow from ops. Payment of dividends, financing. So no, I'm not picking those. I'm just good. Net book value of equipment sold, that's investing. Increase in AR. Okay, that is operations because that's a current asset if you go back. So change in AR, and that went up by 7, opposite direction, minus 7. Sorry about that phone call. I gotta tell people not to call me when I'm working here. So that doesn't happen in the classroom. I guess it could happen if I have my cell phone there. All right, here's a loss on the sale of equipment, 2,000. Well, we are gonna, even though this is an investing activity, we are gonna have to pick it up here because inside that net income is a $2,000 loss on something that should be investing. So because that was a loss that reduced net income, we're going to add it back. Add back loss on selling that equipment plus 2. If it had been a gain in there, we'd have subtracted. So now we pick that up. Depreciation. Okay. Depreciation, we debit depreciation expense, reduce net income, and credit accumulated depreciation, no cash. So it's a non-cash expense that has reduced that. I've got to add that back. So we've got that. All right. So those are some of the harder ones here. Increase in accounts payable. That is a current liability, accounts payable. So that is does impact cash flow from operations in the same direction. So change in accounts payable. That was an increase, plus 33, plus 33. Prepaid expense. That's a current asset. That is in the opposite direction because it's an asset. So a decrease of 1 is going to be the opposite direction. So a decrease is going to be a plus 1. See how hard these things can be. Decrease in a warranty liability, that's a current liability. That's in the same direction. So change in warranty liability, minus 2. Sale of treasury stock, no, not operations, that is in financing. Decrease in inventory, that's a current asset. So change in inventory. Now, opposite direction, so a minus 8 becomes a plus 8. Issue of bonds, nope, that's in financing. And decrease in salaries payable, that is a same direction, minus 2. So I hope even just working this multiple choice, if you're just only looking at this video, I hope it's scaring you. Like I would probably scare you if we were in class working this. You got to go do this work. And so if we add and subtract all these up, we get to $143,000 in cash flow from operations. Answer is A. So you can see how in the multiple choice questions, you have to actually do a cash flow statement, which if you watch my videos, I do 3 of them in those videos, and I teach you how to do those. You can watch this here, but this is going to be a lot faster paced than the videos. So get back to those videos and use those. All right. Now we're looking at same data, and now we're looking for investing activity. So go try to do that on your own, and then pause the video, work it, and then restart the video, and you can see how it works. All right, investing activities, they are about long-term assets only. So only changes in long-term assets are going to show up in the investing section. So net income, no, that's in cash flow from operations. Okay, acquisition of equipment with cash. The company paid $25,000 in cash for equipment. So cash flow from investing, we start with purchase of equipment minus 25, because that was a negative on cash. Payment of dividends, no, that's financing. Net book value of equipment sold, okay, we are going to pick this up. So net book value of equipment sold is 30,000. So this, this equipment went down by 30,000. We know that's the opposite direction for assets. That'll be a plus 30, but you have to think through this. How much cash did the company receive? They didn't receive 30,000. If they'd received 30,000, then they wouldn't have had a loss. They had a loss on that equipment. And so equipment sold would have been 30 minus 2. They only received cash of 28,000. And I'm going through here. Nothing else here relates to a investing activity. And so we end up with answer minus 25 plus 28. Answer is plus 3,000. Answer is C. All right. Next. And this is the, again, same data as before here. And this time we're looking for financing activities. So go try your hand at that and then come back and we'll work it together. All right. Financing activities, they are all about long-term debt and equity. So only transactions in long-term debt and equity affect the financing activities. Because what's in financing activity? Hey, where's the company receiving, what's the source of funds that they're using to capitalize the business? You finance majors should just be all over this. And so let's just go through the same data again. Net income, that was cash flow from operations. Purchasing equipment, that's investing. Payment of dividends, oh, that is financing activities. Cash flow from financing. Where do dividends come from? Remember, we debit retained earnings, credit dividends payable. So it's a reduction in retained earnings. Payment of dividends, paid in cash, right? So credit cash, debit dividends. So it's going to be a cash outflow. Minus 10. So we picked that one up. No, net book value of equipment sold. No, that is about investing. AR, accounts receivable, that is operations. Loss of equipment sold, that's all about operations and investing. Depreciation, no. Accounts payable, no. Prepaid, no. Warranty liability, no. Ooh, sale of treasury stock, an equity transaction. And so we sold it. So we're going to receive cash, debit cash for 50,000, credit treasury stock. So you kind of have to go back to the journal entries here. And so sale of treasury stock, that's going to be plus 50. We received cash for that. So we've got that one taken care of. Decrease in inventory, no. Ooh, issuance of bonds, long-term debt. That is a financing activity. Here, see, look how we can test you in these multiple choice questions and test you on other chapters in the book, if you will. How much cash did the company receive? 100,000? No, because they sold them at 80, which represents 80%. And so issuance of bonds, the company received cash of 80,000, 80% of 100,000. And then here, this is no. And so here we go. What's cash flow from investing? Minus 10 plus 130. Answer is going to be plus 120,000. Answer C. And there you goes, guys. We'll just come back to the main screen here. There you go, guys. There is my review for chapters 10 and 11. If you missed any of these, you will miss more than one multiple choice on the exam. There are multiple choice around each of these kind of concepts. If you are struggling, if you're intimidated by this, don't be. Go back to my YouTube lectures. Look at those. Practice the problems that exist in those. And get back. And you do not have a lot of time here. You need to start now. If you're watching this for the first time Wednesday and you don't understand this, well, I want to have a harder conversation with you, because 2 weeks ago I laid out a game plan for you to make 100% of this exam. That would be kind of shame on you. So sorry about that. So you really have to get in the game here. But hopefully you've been following my game plan and you're going to make 100% of the exam. I wish you guys the best of luck. Thank you. And again, have a great summer. I hope that you're going to make an A on this next exam and that you are not going to be taking the final exam. Thank you, guys. Bye.